let's turn our eyes to the market, John. Stocks still clinging to their record highs, and that's why you may have heard some in the financial news talking about a possible major pullback. But Morgan Stanley's Mike Wilson, he disagrees. He tells CNBC, in his opinion, we're at the beginning of a new bull market.
The sell-off in April was really a final capitulation to a bear market that began last summer. If you actually look at most stocks, they topped in July of 2024. They were down anywhere between 30 and 35% on average. I mean, that's a proper bear market that ended with a capitulatory price action. Most bull markets don't last 4 months. They last, a year or two at a minimum. So I think right now we're in buy the dip mode because we're in that bull market mentality. And that's really going to be contingent, in my view, on when the Fed starts actually cutting interest rates. But once they start actually doing that, that's when you'll probably see the bull market really broaden out.
Now, John, I know longtime listeners of the show are familiar with your thoughts on the market right now, but let's talk about what he said there and how you guys balance capturing, market growth while still preserving, some degree the income that people are going to need over the 20, 30 years in their retirement.
So, Chris, what we have to do is look at, where they are today, where they are now, as far as not just dollar amount, but look at the actual positions that they own. What is the basis in them? Is there, what is the risk score? What is the beta? What is the standard deviation of each individual position? What is it as an overall portfolio? We have to look at, are these positions they're invested in, are they income producing positions, or is there going to be, or do they have to sell a position over time to create the spendable income? So we have to look at where they are. And so you have to, what we saw earlier this year because of the Trump tariff tweet situation, obviously there was a market sell-off. The market has obviously since rebounded and sitting around a 10% return, if you're looking at the S&P in general for the year. So, I mean, look, if you look at that, we're in September now, so that's not a big, that's a good, return. There was some turbulence at the beginning of the year. I think there was a lot of emotional decisions made by some people that were, some people, and I say some, there's a lot of people that across the board, across the country, had sold off. And we look at the technicals, the relative strength index, the moving average. We know right now the market is overpriced. Now with the one big beautiful bill there's a lot of, there is room for growth, but we have to look at, and it's really that Magnificent Seven that has the majority of the growth. If you look at the bulk of the S&P 500, it's flat to, barely withstanding, inflation. So, we have to understand the mechanics of how the market works and look at, okay, what is the big picture? What are you trying to do? Are you trying to get 15 and 20% returns a year? Are you trying to preserve the capital that you have and get a near or a double-digit return each and every year? But what if you can... what about looking at going that route and trying to remove the volatility from the situation? Because whenever you're in retirement, the sequence of returns risk is one of the biggest risks that you have to deal with. And what that means is when you're taking a distribution from your portfolio in a bear market, you're locking in a loss and you're selling at a discounted value, removing money from the portfolio. So you're going to shorten the lifespan of your portfolio by taking that kind of action. So we have to look at, if you are either in retirement, near retirement, we have to look at in that phase of life is removing as much volatility as possible on the money that you're taking distributions from. That's why we want to have assets organized in, money that you're going to use now, like an emergency fund or planned expenses. Those dollars should not be tied up in any kind of position where you're going to have principal loss. So using money market accounts and CDs, having cash, treasuries, different little things like that, you would utilize to make sure we have the liquidity, but also the market, the preservation of capital at the same time. Now, the middle bucket, and what we call it in the office, the soon bucket, that bucket is tied to different positions, different investments, different holdings that generates interest, dividends, some form of income, not being in a guaranteed income annuity. That's not what we believe in here. So what we want to do is use the correct vehicles that could spit off the distributions and remove the volatility as much as possible. So what's utilized there is there's options that we have that have a stop loss of zero, and we have other options that have some little bit of negative market fluctuations, but it's very minimal. There's triggers in point because it's a tactical driven portfolio that is designed to remove itself whenever the positions are at a point where they're drowning in value, and it's appropriate to take an exit and find another position that generates either a positive return or a stable return or a stable dividend. So that's the things that we have to look at is, what part of your money you're talking about. Now, we could also have assets in a long-term bucket, which is focused for really long-term purposes, long-term capital appreciation, long-term growth, replacement money for later on down the road. But this is money that you're going to put in potentially at a higher risk that you're using for other reasons in the future. It's not money that you're drawing off of. It's not money that you're going to use to buy your camp next year. We have to earmark assets in the right area and understand your risk tolerance and the liquidity need to put the money in the right place so we can have a very diverse portfolio that covers all of our different needs, but it's also blended with our risk tolerance as well.